Rajesh. Thanks so much for joining me.
Thank you, Kiah. Happy to be here.
Well, I am so excited to talk a little bit about the paper that you and your co-authors did, The Decline of Branch Banking. I came across this paper because it was part of the papers presented at the 2025 Community Bank Conference hosted by the Conference of State Bank Supervisors and the Federal Reserve Bank of St. Louis. I have attended that conference for a couple of years, and I was a panelist one year. Tell me a little bit about the 2025 conference before we dive into the paper.
It's a great conference that Joe and his group put together. And I particularly like the interaction between the academics. And, the academic papers are discussed by industry executives.
Yeah.
And there's always a regulatory presence, too. So you get all perspectives. And I think that's what makes that conference really special.
Yeah, I love that dynamic, in part because, this is not a critique of what academics do. Obviously, these papers are they need to fulfill a lot of things, but sometimes I'm just like, that's not how banking is. The way you have envisioned banking in this paper is not how I experience banking as a bank reporter. And so it is interesting to have that, have your paper kind of tested by someone who has to do this for their job. And then to have to interact and share what are the implications? That was the first conference where I realized that there was a lot of research being done prior to greenbacks, dollars, US dollars issued by the currency. And the first time I realized there was a lot of research being done about prior to the FDIC being established. And I was like, why do we care about this?
No, it's very important. If you're dealing with the current times, you are in some senses a student of history. Let's put it that way. Right. And, there are very, very fundamental questions to banking to be able to understand changes in banking. Today we're raising questions about what exactly are the regulatory perimeters of a bank.
I know. Yes, we are.
And, these perimeters have been changing over time, right? We call them shadow banking, things of that nature. But I think it helps us understand the distinction between function and form.
Sure.
So what are the key banking functions that are essential? Why are they not being able to be performed by other entities? What's so unique about banks? Doug Diamond won a Nobel Prize for just articulating this very well.
Exactly.
It's very important.
Well, and I will say that learning about wildcat banking did prepare me for the stablecoin conversation, and also really helped me be like, sorry, why does anyone want this? I thought we already went through this experiment, but we are here today to talk about your research, which does look at a period of banking after the FDIC was established and after we have greenbacks. And it is about branch banking. So first off, tell me a little bit about your research and how you and your co-authors became interested in looking at the variables that drive branch closure activity.
Well, my area of interest has always been banking. And so, so I have some early work where I was looking at around the Glass-Steagall relaxation times as banks were expanding their product offerings. What was that doing to the industry? And Phil, one of my co-authors, and I were both at the FDIC conference, the annual conference. I was presenting the paper. Phil was presenting some other work, and which is related to the decline in branch banking. We're observing some things, and Phil was the chair. And Phil had done some early work with IBEA, which is the relaxation of branching restrictions in the United States, and a lot of work on that. So we got to talking, and we put together a lot of sort of empirical observations. And asked, why is this happening? And I said, why don't we just sort of investigate? And I think that's typically how most papers are born. You see some stylized facts, that are happening. And then you say, okay, why? And, and can we sort of examine this in more rigor and detail. And that's how the paper came about.
So I also am familiar with the concept of a bank branch and of the trend in opening and closings, and there's been a lot of closings. And so, but I just actually had assumed that everything was an individual decision by banks. And so if you have 4,000 individual decisions that all tend to be branch closings, you'll just have more branch closings. Your paper kind of can accept that, but also found maybe some other reasons driving branch closing. So what are the main findings of your paper? And then without getting too much into kind of the nuts and bolts, which we'll talk about, how did the bankers react when you presented this paper?
I think the headline finding is that a lot of this industry restructuring, by which I mean the reduction in the number of branches that were physical branches that we're seeing in the United States, is being driven by economic activity on the deposit side and not so much on the lending side.
Okay.
Not so much on the credit side.
Yeah.
So that's sort of, I think, one of the things that, we're a little bit pleasantly surprised, but maybe not too surprised given everything else that we've also been reading. So the deposit side, the deposit business seems to be one of the primary drivers of why banks close and open branches. And that explains a good part of this restructuring that we see. And we link that to the advance of technology over the years, which has changed the way people bank. So how did the bankers receive this?
Yeah.
I think, they're seeing the number of branches decline.
Right.
And each banker has to think about it. And so I don't think they were surprised at the stylized facts.
Sure.
I mean, it's the academic's job to abstract away and look at the forest from the trees. And so while some of the bankers use the term deposit franchise, a lot of the community banks may not necessarily be using that term, but I do think that they understand intuitively as part of their business. I mean, they're smart bankers. They're trying to be profitable with their branches. So they're looking at what is that optimal mix.
Right.
And so I did think that it resonated, but perhaps the terminologies were just a little bit different. That's all.
So your paper found that prior to 2010, branch openings outpaced closings by 2 or 3 to 1, even as the number of banks was shrinking through consolidation. So we have fewer banks, but more overall bank locations. Why do you think branches were peaking in 2010 and not earlier or later? Like, what was special about 2010?
The global financial crisis. We're coming out of the 2008-2010 period.
Fair.
Okay. Probably the singular most event that has happened in the last 50 odd years in banking for us.
So you think that the losses were so great from the financial crisis that banks just stopped opening branches?
It was a shock to the system, right? I mean, so you had Dodd-Frank come in.
Yeah.
And so we had to completely, so bankers started looking very differently. So the period between what I would say roughly the 1990s when Regal Neal was passed, where banks could then freely branch across states, which had sort of been happening from the late 80s, I think accelerates. And you see lots of consolidation. Banks enter new markets by buying other banks and branches. And then over time, I think that peaks and technology is beginning to develop. 2007 is when the iPhone makes its appearance. We're getting more and more into online and digital banking. And then, capital levels in banking are short.
Yeah.
After the financial crisis, everybody shrinks.
Yeah, I actually just read an essay yesterday that talked about, there's this mythos that the ATM did not lead to fewer bank tellers. It led to more bank tellers. I'm sure you're familiar with this paper or this assertion. And the essay or the newsletter asserted that, sure, yeah, that's because when you try to automate something a human does, you don't necessarily replace the human. You can just make that human's work more important. But that the technology that truly kind of killed the demand for bank tellers was the smartphone, which like kind of is something that is just kind of happening in parallel to our financial crisis. Like I'm sure even if we don't have the 2007 financial crisis, we still get a smartphone. And so maybe it takes a little bit longer for the costs of branches to kind of become this cost center, and it's harder to get the benefits of it. But we still have that smartphone coming. And so the amount of tellers goes down after, I think, 2010 as well.
We didn't look specifically at the tellers because we don't get that kind of data in the publicly disclosed bank information. But the technology aspect is very evident post-COVID. So pre to post-COVID, right? COVID was this teachable moment where everybody said, okay, I have to, even if I was resistant to trying to sort of bank online or bank digitally. It forced my hand, and then you begin to see this dramatic change post-COVID.
I remember one reason why I was so excited about this paper is that I wrote an article in like 2020 or 2021 that was like, should you just close 20% of your branches? Like some of the branch closures we were seeing, especially from, we will get into this, the community bank space, so the 20 billion and under, was like 20% of their network, which was kind of nuts. But we'll get into a little bit more why banks are able to do that. So you mentioned deposits as kind of being this big determinant about where banks close and open branches, which is really interesting because I think like deposits means customers. So your paper isn't just about metros, it's kind of about demographics, and it's kind of about the context of like where any bank should open a branch relative to a neighborhood or a commercial district. So your paper talks about something every bank knows, which is that not all deposits are created equal. Some deposits are hot or they're sensitive to interest rates, and some deposits are sticky and not sensitive to interest rates. What did your paper find about how deposit behavior factors or plays a role in a institution's decision to open or close a branch?
I mean, in some senses, that's one of the big punchlines of the paper, which is that depositor behavior, which translates into the value that banks derive on the deposit side of their business, which is what we call the deposit franchise, is a major determinant of this, the decision to open and close branches. Okay, I mean, let's just take closing of the branches. I mean, think about how a bank makes or derives value from the deposit side of the business. It does so by paying interest rates on deposits that are lower than that of what the market rates are, right? And so that difference, that spread, is what I make on the depositors as long as the depositors stay. So I'm going to adjust my rates depending on how I think my depositor, my customer base is. And if they are sticky, I can then maybe not raise rates as much when interest rates in the market are going up and still keep them with me and then derive value from that. Alternatively, I mean, if they are moving, they're very flighty. In other words, today with technology, they can just move to any other bank or a mutual fund, a money market mutual fund. Then my ability to, if you will, in econ speak, extract rents from depositors, that means the value that I can derive by paying below market rates, which is what we call the deposit franchise, diminishes. So it's the demographics, it's the customer base, where the branch is located and how those customers behave that we find determines to a large extent which branches banks close. So our study was very, very careful to look at branch closings within a bank. So we're saying whatever the bank does, it chooses to specifically close in certain areas and not in other areas. And what drives that difference?
So, and your paper argued that within a bank's footprint, the bank will is more likely to close branches if the deposits are at that branch are hotter, or
Yes,
if
they're
the
flightier.
neighborhood around the branch is more either
Correct.
uses technology more, or is, I think you said, higher education, right?
Well, those are just demographic proxies to paint the picture that banks are closing branches in areas where the customers are flighty, are hot,
Okay.
because they have other options, because they can use technology and others. And secondly, it's also a population that doesn't place a whole lot of value on, or the amenity value on, a branch.
I see.
They're not about going to a branch physically. It's a generation that, or it's a demographic that feels very comfortable banking online as opposed to having to go physically.
Yeah. Yeah.
And we actually show this, that you know, the distance that people travel to the branch. I mean, we use some novel cell phone geolocation data to actually pinpoint this. And we show that the number of visits to branches have declined.
I mean, speaking for myself, I only go to branches if I need to get, very specifically, if I need to use the ATM that gives out small dollars, and I do it when I travel. And so like that, I mean, sure, my deposits are at this bank, but when I'm going to the branch itself is a very specific transaction, and it's not frequent.
Well, that's the part. That's what I'm saying. I don't think this is surprising that people
No.
are not visiting branches. People
Yeah.
are using more technology. I think where our paper comes in and makes a contribution is, what does this imply? How do we connect this to the restructuring that we see in the industry?
Yeah.
I think that was the leap we make in this paper, and I think we sort of show that out.
And I think it's important. It's important too to understand that, like, you might. I think this paper is really interesting in 2026 or 2025 after we've had the interest rate hike, right? Like, if you present this paper in 2021, probably a very different paper.
Yeah.
I think now the appreciation of depositor flight and understanding why do I need to understand why my depositor puts their money at my institution? Is it rate? Is it something else? And how can I, if I'm trying to not compete on rate, what are other things I need to compete on in order to keep this money, and to keep this money at like the price that it stays at my bank at? Your paper also found out that like lending is not a determinate relationship to branch closures, which I thought was so interesting. Why is it not that important that bank branches be physically close to the borrowers?
Well, we're not saying that lending is not important. I do think that local lending and local lending relationships still matter for a lot of community banks.
Okay.
All our paper is saying that that's not driving the branch closure.
Sure.
So there's a distinction there.
Okay, fair.
So, but we have some other work that's happening. We were actually a little bit surprised. I mean, in the sense that, again, remember, these are studies that are trying to paint a picture based on averages and medians. There's always going to be differences. So when an individual banker looks at it and they say, yes, local lending relationships matter. But on the whole, if you look at it across the U.S. banking industry, that force doesn't seem to be driving why they don't close.
Yeah.
I mean, even prior to this, when banks were expanding into new markets, it was primarily in search of deposits.
Yeah. Yeah. I also think about how banks would, historically, when a bank moved into a new geography physically, they would often hire a team from another bank to bring over the relationships, and they would open a loan production office. And then kind of once they got that office going and that office was bringing in loans, then they might open the branch in order to, fund those loans.
Right.
And I do think that, just that even that order of operations tells me that, lending is kind of its own beast, and it might be more of a relationship between a banker and a borrower and not the relationship between a borrower and a physical branch, right?
Yeah, absolutely. I more so for small businesses and small banks.
Sure.
Small in the banking world is, less than 10 billion.
Yeah.
Which is for most people not small.
So, your paper found a divide between small banks and large banks. And why do you think there's this difference between how large banks will close and open branches and small banks will close and open branches?
I mean, what we find is that large banks, and we looked at those above $100 billion in asset sizes, their business models are a little bit different. I mean, their geographic footprints are also wider, right? Broadly speaking. So they have more branches. So the pace of branch openings and closings is to a large extent driven by large banks, not so much by the small banks. So that's sort of the distinction. What is happening is I think banks are thinking about how do they optimize their physical and online footprints. Earlier, when you were thinking about your market strategy, you thought of it in terms of physical geography. Where do I put all my branches to manage my business? Now you're still trying to sort of maximize the value or from your business, but you're now looking at engaging in that business both through physical channels and online channels. So it's like saying I have another distribution channel that I did not have in the past. And now how do I reorient my ways to look at it? And this is sort of in the long sweep of over a decade. That's what you see banks, each bank working this out.
Yeah.
I mean, banks are still opening branches, physical branches. Okay?
Chase is opening a branch every 3 days this year. Every 3 days they're opening a branch.
But again, that's Chase.
Right.
Okay. I mean, and there are a few others, okay, that you could count. But on average, that's not what's happening in the United States.
Yeah. Well, okay. So going back to what I said about how the technology of a geography, a neighborhood, a metro, even like a suburb of a metro, your paper does find, proxies of education levels and stock market participation of people living near a branch and that branch's fate. This brought up for me, like thinking about this like demographic area, this made me think of the Community Reinvestment Act, where a bank's assessment area will include its footprint. And then you kind of look at the like demographics and the income levels of that footprint. And CRA ratings matter to banks because they impact the bank's ability to expand, including new branches. So if you have a bad CRA rating, you're actually not allowed to open new branches. And I think the concern there has been historically like everyone needs access to banking services. And so you want to make sure there's a meaningful financial presence in low and moderate income communities, or historically maybe disadvantaged communities. And you don't want banks to the regulators didn't want banks to open branches only in rich people areas, right? Or economically advantaged areas. Okay, so that's my premise. Given your paper and what you found about where banks open and close branches and why, and the CRA with this assessment area, what should we think about when we think about geography and demographics impacting branch closures and openings? Like, in what way do demographics matter to banks?
Demographics matter because they imply what the rate sensitivity of your customers are.
Okay.
I think that's the big point. I mean, certain demographics bank differently.
Okay.
By that I mean they're more comfortable banking online digitally. They're a lot more sensitive to rate changes because they're very comfortable moving their money very quickly across institutions. So that's why your depositor base, the demographics of your depositor base begin to matter quite a bit.
And so those, what kind of demographics indicate potentially more interest rate sensitivity and what kind indicate less?
Typically, it's age.
Okay.
So, if you're older, you're less likely to be tech oriented, let's put it that way, right? I mean, so the younger the population, more educated, higher levels of income, all the things that you would normally think about people who are associated with technology adoption seem to sort of proxy for what we see.
But Rajesh, that's demographics today, but like in the future, the young people who are comfortable with technology will be the old people. Well, what are banks supposed to do if we're all just going to become increasingly more comfortable with technology?
No, I mean, if you take it to the limit, we're not saying that branches go down to zero in the world. I mean, remember, these papers are showing you what is happening, if you will, to use an economist term, at the margin.
Okay.
It's not like other things are not changing. So it's not like the branch is not useful for other purposes. By that, I mean the physical branch. But at the margin, what's dictating this change is what's happening on the deposit side.
Yeah.
Clearly, we find that after COVID, right? I mean, even if you want to say less sophisticated people pre-COVID had to become sophisticated.
Yeah.
If you want to use that term, financially sophisticated. There is evidence of that. So we're all increasingly adopting technology.
Yeah.
Right. But as you get older, as you have more income, your needs also change.
Sure.
It's not purely transactional. You may now go into the bank because you run a small business where your business and personal banking are related. You may go in for wealth management services. I mean, so there's a whole host of other things that, location still, physical presence still matters. All that we're saying is that it's now, physical presence competes with online presence. And different banks have to figuring out what this optimal balance is given their customer bases or the bases that they seek.
Yeah. And the other thing, too, is obviously we're talking about branch closings. Your paper also actually touches on branch openings, too, right? And so I wonder now that, and your paper uses geospatial locating. It's interesting to think about what kind of data do banks have that they're incorporating into where should I open a branch? Do they know I think about with Chase, I have this theory with Chase, they have a lot of data about where their customers have credit cards, and then they have all of the transaction data, which would indicate where their customers spend money. And so if Chase is looking at demographics, like where in the United States is population moving and growing? Where do we not have branches? So obviously expansion opportunity. Where do our customers live and where do they spend money? And where is like a nexus within that's a reasonable distance? This person is not going to come to the branch, but they're going to need to go get cash for tips for when they travel. Where can we put a branch that seems like that is convenient enough to them that like maybe we don't have their deposits, but if we opened a branch, they might like consider having their deposits, or, maybe I'm in my personal experience, I had a bunch of Chase credit cards and then I opened a Chase deposit account to make it a little bit easier to kind of manage my finances and pay the credit card, whatever. And what do I know about the different places of Charlotte or Nashville? Where do people of certain income or education levels or stock market participation live? And how do I know that through the transaction data I actually have on these customers themselves, right? There are implications about where to grow from your paper.
Absolutely. I mean, the short answer to your question is banks have way more data than we have.
Yeah, sure.
Or we had. Okay. We are using pretty much publicly available data. So a lot of the demographic data is from the census or Bureau of Labor Statistics, and those kinds of government bodies that provide this kind of data. We use some cell phone geolocation data, but banks know their customers, right?
Yeah.
I mean, they have. See, the interesting thing is all our transactions today are being, to some extent, digitally captured.
Yeah.
I would say to a large extent, digitally captured. Okay.
Right.
So banks have this data. Now the key is to be able to extract information from it and use it strategically.
So you mentioned earlier, the deposit franchise, which comes from the value of which comes from the ability of banks to basically underpay their depositors from the market rate. And that has been a big problem for banks in the last couple of years. And one of the reasons why is technology. Technology just makes it so much easier to move your deposits at a bank that's not paying you the market rate to a bank that will pay you closer to the market rate, maybe through a high yield savings account, or into just a different type of financial vehicle like a money market fund. And I feel like before the big interest rate increase, technology was actually the tool that banks were using to bring in deposits. And now technology has kind of become the tool by which deposits leave. Is there a scenario where in like 20 years, technology has actually flattened the idea of a deposit franchise value and that banks have to now pay the market rate because it's just too easy for money to move?
I mean, theoretically, it's possible, right?
Okay.
I mean, everybody is... So money moves instantaneously. Notice what the reason I, as a depositor, am willing to accept below market rates at my bank is because I derive some value from the convenience of going to a bank. This is what economists call the convenience yield. Okay, so I'm going to have to basically give up that convenience yield. So what you're arguing is that in 20 years' time, the convenience that I get from just being all the convenience that I get is online, if that is indeed the case, then there would be no deposit franchise as measured by this particular metric, right? But I do think that people value the convenience of going to a branch.
Yeah.
Okay.
Well, and I also think that, like, even if the rate paid on deposits was equal to the Fed funds, non-banks still want to become banks because paper, like, wholesale market funding is more expensive than the Fed funds, right? Like, they're still like the banks are focused on this like deposit beta between Fed funds and their cost of funds. Non-banks are focused on a funding beta that's basically probably market funding and Fed funds, and then maybe even less than Fed funds, right? There's still that's still very cheap funding overall. But I actually do think that, if you have to pay more on your deposits, then you have to change some of your loans, right? Like, you're just going to have to, everything's going to have to kind of flow downstream from how much money does it cost for us to borrow, right?
True. I mean, but it also, raises the question, what exactly does a bank do then? I mean, is it just simply is it a money market mutual fund then?
Right.
And the argument is that that's, or at least what we know from the history of banking, is that that's not quite the case, right? I mean, banks make loans. I mean, they're uniquely positioned to make loans off of the deposits. So they're not, and these loans are illiquid.
Yeah.
Right? So you need somebody in the economy who can make illiquid loans, but fund them with highly liquid deposits. And that is not an easy thing to do. And that's precisely why you have banks.
Okay, so again, I think this paper has really interesting implications post SVB, right? If the SVB, the failure of SVB, like, I can count at least like 20 papers that came out of that failure. One of them was that post SVB showed that banks that had low branch density had used digital channels to grow uninsured deposits, which had accelerated their rate of growth. And then there was another paper that found that banks that had brokerage services and like really good mobile apps saw faster deposit outflows when rates rose. So we have, on one hand, they used They used digital channels to bring in these uninsured deposits. And then on the other hand, once rates rose, the deposits left faster. Your guys' research is downstream of these two things, which is about the branch closure, which would be kind of that like final thing. Between these findings, is there a concern that closing too many branches means that you'll have to rely on digital channels, which then means that hot deposits could leave very easily over the same digital channels? Therefore, bank fragility increases. Like, are we just all replicating SVB over and over and over again, which SVB had like 20 branches when it failed?
Well, SVB, just to be clear, SVB was an outlier. Remember, they were funded with their mark-to-market losses was just about the median. So interest rates went up, asset values went down at banks, but SVB was not an outlier there. Where they were an outlier was 97% of their funding was uninsured. Deposits, okay.
Which used to be really valuable money. You used to want to have big deposits because you had that meant they were commercial deposits. Like, everyone says they're risky now, but like 2021, that was good stuff.
Well, it is to your point. I mean, that technology has enabled you to grow faster, but also fail quicker.
Sure.
Another way to put it is that your deposit franchise has become, it's a source of value, but it's also a source of fragility.
Right.
Okay. So yes, have deposit franchises become more fragile? So think of the deposit franchise as an intangible asset that you have. Right?
The stickiness, the amount that it costs you. Yeah, those are those.
You're deriving some value from your deposit side. Where do you put it on your balance sheet? I mean, it's some sort of value, right?
Yeah.
But it's not something that I can write down.
Right.
But it is an intangible asset that sits with me.
Yeah.
But it can vanish very quickly. So it's very fragile.
Yeah.
It's great, but if you have it, which is equivalent to saying, it's great if my depositors stay, but the minute they change their mind, it can cause dramatic changes in my value, right?
Yeah.
So, yes, deposit franchises are more fragile in a technology era where deposits can move very quickly.
One of my arguments with that branch density paper was I kind of felt like they knew what the like end was, which is that SVB fails, right? So I felt like they were kind of back ending the entire paper to explain some of that.
A lot of people are trying to understand what exactly happened. I have some work also on that. It is a little bit unique in compared to how we've seen banks fail in the past.
Mm-hmm.
Okay. We're used to thinking about credit rate risk, bad
credit
loans,
losses,
and, that kind of
capital
stuff.
erosion, yeah.
This was an interest rate risk shock. It's not that we've not had interest rate risk related failures. Think about the S&L crisis in the 1980s and early 1990s. It's just that we've gone through about 30 years where none of that kind of stuff has happened. That's all. And, but lots has changed in the world in those 30 years. And that is, I think, technology and how people are banking, actually.
Yeah. I will say the one takeaway I took from the bank branch density and bank runs paper was not necessarily the digital channels per se, but what my learning was that branches, I think, are very good at bringing in insured deposits, and insured deposits are potentially stickier than uninsured deposits.
Sure.
They may still be rate sensitive, but they are not worried about taking losses and failures. And so if you are a bank that wants to cater to high net worth individuals on the coasts, so you open 20 branches, those people are going to bring in, especially if you are deliberately trying to bring these people in as customers, those people are going to bring in large deposit balances. They will have them personally, potentially. They will work at companies that have them. And if you do not have a poor person retail strategy that can augment those branches or those types of deposits, then you are more fragile. And it wasn't the branch, it wasn't the amount of branches, it wasn't where the branches were located. It was kind of a deliberate decision to attract a certain type of customer that would carry with them certain types of, benefits and certain types of risks. And
absolutely.
And I was like,
SVB's the poster child of this, right?
I know.
mean, what you're saying is that banks need to be cognizant of their deposit mix.
Right.
You need a certain amount of insured deposits. You need a certain amount of uninsured deposits, right?
Right.
So that is the way you manage interest rate risk. And look at what SVB did. I mean, it's not that they didn't know. And it's not that the supervisors, the regulators were telling them that. I mean, management realized this and they went out and tried to raise capital, and that's when the market got to know, and
I know,
$40 billion left in a day. So the speed of the runs have also increased so much.
Yeah, and I will say it's really hard to raise $40 billion of insured money. So that's the other thing too, is like if technology is making deposits more sensitive and faster, it's going to take a really long time to bring in that much insured money. And that's maybe where some of that branching strategy comes. You're not just opening a branch for next month, next quarter, next year. You are looking for overall deposit stability, overall deposit mix, right?
Sure.
And trying to attract you, and you have to balance that, like kind of household, individual, depositor, and the corporations as well, right?
Yeah, there used to be a benefit when you expanded geographically, because the local economies were disparate. So, right. So you could have some deposit stability that came about because you were geographically diversified in your sources of deposits, right?
Right.
I still think that geographical dispersion in terms of like the local economy is doing well. So if my economy is doing well, I'm going to get more deposits. That still exists, but it's probably not to the same extent that we had in the 1980s and 1990s, because regionally, the U.S. is a lot more integrated now than it was then.
One of the weirdest topics of SVB, and it kind of has implications to your branch paper, was that there's two banks that might have had more depositor outflows, except for the fact that the holding company name is different than the names that the bank units use. So on the branches in different towns, these towns have, let's say, like First Bank of Scottsdale or like, Bank of Tahoe, and they don't have the holding company name that was in the financial press as being like, is this bank, regional banks, customers, like pulling out all their money? And it's like a data set of two banks. So it's not a good data set, but it is really interesting to think about, again, that idea that the retail depositors, or maybe even an uninsured car dealership in some town, didn't pull their money because they didn't actually have that connection. The way that, we think about SVB or First Republic's borrowers being very, like, probably pretty sophisticated, very interconnected, right? And also they don't have the benefit of like having a brand name that's different than the holding company, right? And then it's kind of like about marketing at this point. Like, you just need kind of a decoy bank to like keep your insured depositors from moving, right?
Yeah. I mean, I think the question you're asking or hinting at is, what is the signal on which depositors coordinate in a panic? Yeah. So let's say I hear, oh my God, SVB failed. Okay, now, what does that mean?
Yeah, what does that mean for me? Yeah.
What does that mean for me? And if I am behaving, if it is a panic, let's call it that way, then what am I basing my decision on? Some common signal. And I think that's sort of what you're saying. I mean, are they looking at the mark-to-market losses across all banks? Or it's just like, man, I don't know about my bank, right?
Yeah.
And so, that's an open question. That's an historical question for backwards. But I think the preponderance of evidence, again, over, I would say, almost 150 years of history, is that banks have failed, at least in the United States, that we know, which we have very good data on, that primarily because of fundamental reasons. It's, in other words, the bank was not doing well, and hence the depositors took their money out.
Yes,
it's not
yes.
It's not that the bank failed because the depositors took their money out.
Yeah. Chicken and eggs over here.
Yeah. But that's a very important thing because it has
Right.
very different policy implications, right? I mean, if depositors panic and take money out of good banks, then we have a problem in the system.
Right.
So, yeah.
So bringing it back to opening and closing branches, if you were advising a regional bank CEO, so let's say one that's like below 75 billion. So they've got a branch network, but they're not like a money center. And they want to rationalize their network. They want to open in good branches. They want to open some branches and they want to close some other ones. What would you advise them? What kind of data would you tell them to look at? And maybe what kind of types of cities or demographic trends would you tell them to look for based on your research?
I mean, if you just think of it in terms of deposit, break it down to its elemental components. It's about deposit acquisition costs and deposit retention costs. So that's what a banker has to look at. And the channels follow. So if your acquisition costs are lower through online channels, then move towards online. If your retention costs are lower on a branch side, move towards the branch side. And so, I mean, you're going to have to figure out this mix. One can write out some abstract mathematical formulae for this, but I think, these are simulations that bankers will do to figure this out. They're doing it intuitively, whether they realize it or not. Banks are optimizing in their own way. Each bank is optimizing in its own way. And none of the strategy is sort of static, right? What is optimal today may not be optimal 3 years later. And it does take some time to put up a branch, right? It's becoming shorter and shorter. I see new ones come up real quickly, but it's not just the physical location and presence also. What is the business that resides within the branch matters. There are staffing costs, training costs, all of that kind of stuff is there. Now you have AI. So there are lots of structural shifts that are happening in the economy, which will change the way banks respond to it.
Yeah, I've been writing a lot about the role that physical places play in banking, because I do think, obviously I didn't start this year, but we are, I think, increasingly at a place where to say, like, does it even make sense to be thinking about geography, like physical geography, as it relates to where a loan is made or where to open a branch or CRA, right? I think about like the summary of deposits, right? I bank at an online bank. So according to the summary of deposits, my deposits might be based in Utah or might be based in California.
It depends on where they're booked.
That's not true.
That's right.
And so like if we keep relying on physical geography to tell us these things and we can't find different ways to track that information, well, what does that mean about where anyone makes a decision? Or what does that mean about like when a regulator is like, well, you seem to have a lot of deposits in Utah, and everyone knows that they just have to be domiciled somewhere. The deposit has to live somewhere. And our systems, our regulatory systems, our way of like measuring all these things is based in something from the 80s,
Well, yeah. I think we see that across a variety of economic activity, right? Measuring economic activity in a digital world is not very easy, and our systems were not designed to measure them for this world. And I think they're adapting. But yeah, you're right. It's where is geography in an online world?
Exactly. The cloud. I think it's all the cloud.
The cloud. So it's amorphous. Yeah.
Well, Rajesh, thank you so much for talking about about your paper, The Decline of Branch Banking. I'm sure we'll have to talk in 20 years where we will need to update this paper to find out exactly what the value of the deposit franchise is.
Well, I hope we talk sooner because you raised lots of interesting questions that I may have to think a little bit more about. But thank you for a very, very interesting conversation.
Of course. And if I get cited in your footnotes as a thank you for contributing a research idea, I'm going to be over the moon. So I would love that.
We will definitely do that.
All right. Have a great rest of your day.